Hello and welcome to Switzer. I'm Paul Rickard, filling in of Peter Switzer. Speaking of Peter Switzer, he actually joins me as the first guest tonight, live from Rome. And Peter will be following up on a couple of really important things for our market this week. First of all, we have the US Fed on Wednesday night our time, followed by Australian unemployment data on Thursday. And I'll ask Peter about what that's going to mean for our market and what he thinks you should be investing in. Secondly, I've got Adam Dawes from Shaw and Partners. And I want to follow up on that theme about if you're thinking about lightening up in some of your bank stocks or just feel the market's a little bit toppish and want to take some money off the table, what can you invest in if you're looking for something that isn't banks or necessarily resources? Adam Dawes joins me shortly. First up, here's Peter Switzer. Joining me now is Peter Switzer. Peter, welcome to your program.
Great to be here, mate.
Now, it's a big week, both in the US and Australia. We've got Fed Reserve on Tuesday, Wednesday, and the Australian unemployment data out on Thursday. What are we expecting? I want to get to the implications of what these decisions are, but what are you expecting in terms of both those crucial pieces of information?
Yeah, I'm going to go with the optimistic line, Paul, which will be a surprise to you, even though I do have suspicions that there could be a curveball thrown in there. Starting with the Fed decision, I think they'll go 25 basis points.
Not the 50?
No, that's right. Even though 50 is becoming much more popular amongst some of the pundits than, say, a week ago. So on Friday, it became something like 50-50. And it's going to depend on what the Fed thinks the US economy is going to do. Now, my reading of what I've seen so far, I think the safer bet is to say they're going to have a soft landing, and therefore they're not worried about the US economy as much as some experts are. And so I think they'll start off with a 25 basis point cut. But if the data gets worse over the next 4 weeks or so, they could easily go 50 then on the basis that they are worried then. But at the moment, I don't think they're worried about the US economy. So let's just say this. I'm betting it'd be a 25 basis point cut. It probably will be well received by the market. But as you and I know, historically, sometimes you get these situations because we know the US market's gone up a lot lately. And so it could well be a situation of they've bought the rumor, but they'll sell on the fact. But Paul, I wouldn't expect a big sell-off. That's the way I'm seeing it right now, unless the Fed turns around and does a 50 basis point cut. I think the market will be saying, gee, these guys know a little bit more than us about what's actually going on.
So you think in some ways a 50 basis point cut, the market might get more concerned about the potential direction of the economy than they would under 25 basis point cut. Is that essentially what summing it up?
Yeah, I think so. Look, it'd be fantastic for the Fed to say, we're absolutely not worried about the economy, and we're going to give you a 50 basis point cut. The market would love that if they said that, but I can never see Jerome Powell saying anything like that. If it's 50 basis points, I reckon the interpretation will be, hey, these guys know a little bit more than us, and they're more worried than we are. And so as a consequence, I think we're going to have to sell off and take some profit. And Paul, remember this, the last 2 weeks of September historically are the scariest months for the US stock market. So that's one thing to factor in. And another thing is, I just don't think, the market has gone up a lot. So there's got to be some profit takers in there as well.
Okay, and of course, the other thing they might be a little worried about, or not worried about it, take into consideration, of course, it's right in the middle of the US election campaign. It'll be interesting to see what Donald Trump has to say about whether he thinks they're being overly political. So that's a way to see, right. I guess. Now, on Thursday, we get the Australian employment data. What are we expecting there, and what are the implications there in the short term?
Look, I think if I was realistic, I'm not expecting this job number to help anyone out there who's worried about interest rates. Just get clear. if unemployment rises from 4.2% to say 4.5, then I think the Reserve Bank will say, gee, our job is pretty well done. We know inflation's coming down. Now unemployment's starting to jump up a bit faster than we expect. Um, and I'm not expecting a jump of that magnitude, but if they did, let's just take that scenario. If it did surprise and unemployment jumped by a big number, then I think the interpretation would be, this cup day rate cut, which Westpac and CBA are gambling on, might be a chance. And if not cup day, it may well be in December. And Paul, there's a lot of important data between where we are now and the December meeting, which I think is December 7 or 8, but I think December 6, we get the national accounts numbers for the September quarter. And the last one was, very poor, but very low. I think our annual growth rate was 1%. I think the quarterly was 0.2, really small. So the September one could actually be negative, and that would actually set the Reserve Bank up for a cut in December because inflation is coming down, economy is really slowing down. So, but in between, looking at the potential for a cup day cut, you got inflation coming out, I think October 30, and then the next Fed meeting is in November on cup day itself. So I think there's going to be a whole raft of data that will determine whether the Reserve Bank can seriously convey the message to the market that a rate cut might be possible. And if the market hears that, Paul, they'll buy. They won't wait for the cut. They'll buy on the basis of a cut.
Now, you wrote today, Peter, in your Switzer report article that you're a bit at sixes and sevens about knowing what to do at the moment. You want to just explain that and sort of what your sort of basic thinking about, I guess, more so around timing and timing of investment at the moment?
Yeah, it's something that you and I tend not to do with our financial planning clients is time, but the returns have been so good. I couldn't help but recommend, and I know you supported the idea of taking some profit on the banks and holding that money until we thought it was the right time to go back into the market. And because there's so many important pieces of data along the way, I've taken the view, well, I want to see the data first. And if I miss out on the first 1 or 2 days of another rebound, I don't care. I'm a bit suspicious about a sell-off, as our early conversation indicated. And so I know what I want to invest in. I'm keen to be investing in BHP and Rio for next year. I don't think they're going to respond quickly, but next year I think they will. So I'm happy to buy now when prices are low. I'm happy to buy that Beta Shares ETF X20, EX20, because I do think the banks will come off the boil, Wesfarmers, and all these stocks have done very, very well, and they're great companies. But then the part of the market which X20 captures, because it takes those top 20 out and you get the stocks from 21 down to 200. I think a lot of them will do really well and they'll help the market overall go up. And so it is only a question of timing. I'm sure about my investment strategy. It's just when I do it. And I think that's the problem for all investors at the moment. On that subject, even if you went in this week and there was a sell-off later in the week, Paul, I'll be interested to see what you think. I wouldn't expect a big sell-off. I think it'd be more like a profit-taking sell-off on the basis that, and I was staggered. Jeremy Siegel is a well-known professor from the University of Pennsylvania. He was interviewed on CNBC on Friday, and he was talking about how he'd be happy for a 50 basis point cut. And he's kind of implying things to the US economy is slower than other people are expecting. But he was saying that factored in is something, looking at the futures market, something like 7 or even 9 interest rate cuts in the US. That staggers me. Now, if the market even thinks there's going to be 5 rate cuts on an economy without a hard landing, that's got to be good for all those stocks that have been beaten up since interest rates rose. And and a lot did. We know a lot of companies copped it. A lot of companies here copped it as well. And I think interest rate cuts are going to help a lot of those companies in the year or two going forward.
Yeah, I think a lot of investors face the question, Peter, if they don't know what else to do with their money. And so if you're not in the market, where do you put it? And particularly with the prospect of interest rates coming down. So I guess we're all in that same boat. And it does look like our markets, despite our fears, do have underlying strength. And that's why I think you're probably right. If in a bit of a sell-off, it's going to whip back pretty quickly. So I guess, that's the
Mm.
question about look at September. We see it as pretty scary. We know we're coming into a US election. All sorts of things could happen, as we saw, just overnight with another attempted shooting. So, you got to be a little bit careful. But what do you do with the money? And I guess that's what sort of the challenge I have, and I think many investors have at the moment.
Yeah, I think my view is that I might put a part of my money in the market. For example, I might buy a bit more BHP at the current prices, knowing that I'm getting in early. But I wouldn't be surprised if it's going to have a share price in the 40s next year. Sometime it might even be a little bit higher if China comes back stronger than people are expecting. But I just think that the beauty of my current situation is I'm really confident about being in stocks for the next 9 or 12 months, but it's just a matter of when I go in. And if I go in too early, I think my losses will be quite small. And if I keep some cash on the side, I might dollar cost average in. If I buy something at a certain unit price and it drops, I'll buy a little bit more. That could be the best way of tackling it right now. I think, but by the time we get into post-US election in November, rolling into December, I'm sure we're going to see the market having a nice big Santa Claus rally.
Okay, one last thing. You wrote today also, right at the end, about emerging markets, I guess on the back of maybe a
Uh,
long-term weakening US dollar. A lot of
hmm.
people have been burnt investing in emerging markets. How
Yeah, I know. I
are you
know.
just toying with that idea, or are you really going
Yeah,
to
no,
throw that one out there?
and look, I've never really done it, though. I guess I tell a lie. I have invested in a Chinese ETF, which in a sense is emerging economies, isn't it? Um, Paul, but I have noticed that some of those, like the Fidelities one and a couple of other emerging funds have actually been doing pretty well lately. And I think it is related to a lower dollar and all that sort of stuff. But it's for the speculator. That's why I threw it in at the end of the article. Just as I also think good small cap funds will do really well. And I know you and I gave Lilly
Hmm.
Griffith,
Yep.
Eli Griffith, the thumbs up because they're pretty good small fund managers. But I wouldn't mind getting a range of small cap fund managers who I think will do well as interest rates fall. But before I go, there's a question I want to throw at you. There's been a few people saying that there could be some private credit problems going forward. Have you got your head around what the concerns might be there?
Look, I think, Peter, just the concern is because interest rates went up so quickly and so fast. You just expect there's perhaps a bit of collateral damage, and because of the private credit funds, particularly those tending to invest more in some of the commercial property, second tier, third tier type securities and development loans, you just wonder whether these things get hidden for a while, right? I think if they're, enlisted or very transparent markets, problems tend to be seen a lot more quickly. I guess that's just what the fear is, that there's some stuff that's just going to take a little while to come out. I can't point to specifics, Pete, but I think that's sort of part of it. Just that the interest rates have, there was such a quick rise of interest rates, which started in 2022. It's hard not to expect there's going to be some collateral damage there somewhere.
Yeah, and I guess they probably borrowed at very low interest rates, and then interest rates have gone up when they have to re-borrow because their loans have matured or the term
Yeah.
has matured. They're going to borrow at higher rates, and the value of what they've invested in has probably gone down if they're office blocks. So those sorts of funds could be in trouble. But are there any sort of listed private credit players that we should
Nothing that
be?
hasn't been fully disclosed, Pete. I mean, they're all using, of course, valuations, and you always have to be a little bit careful with people and and valuations used in terms of some of the assets that they hold. But there's
Yeah.
been no problems that have come yet to the listed market. So I think that's where it's coming from. But look, without sort of causing anyone to lose sleep out there, it is more just talk. And at this stage, I think we've just got to be just a little bit wary about running into some of those funds at the moment.
Yeah. Okay. Well, I'm off now, being in Rome, to check out Circus Maximus, where I've learnt that in the good old days of ancient Rome, this could take 270,000 people. Like, I don't think there's a modern stadium in the world that can take that kind of number. The old Romans were spectacular builders, weren't they?
Well, you check that out. We'll get on with the show, but thank you for joining us. And with that fun fact, we'll watch with keen interest both on Wednesday night. Effectively, we'll see the impact here on Thursday morning in our time, and now employment data later in the week. Peter
Yeah.
Switzer, thank you for joining us.
My pleasure. My pleasure.
Joining me now is Adam Dawes. He's a senior investment advisor at Shaw and Partners. Adam, welcome to the program.
It's great to be here, Paul.
Look, a big week in markets. The Fed on Wednesday, employment data on Thursday. Markets sort of just trading below an all-time high.
Yeah.
The market outlook still pretty rosy to you?
Yeah, I was just talking to a couple of clients just then and sort of talking about, they were like, well, should we put more money into the market? It's at all-time highs. And I think the market's reacting quite well at the moment. Usually there's a lot more volatility up here at the top end when we get up here. And I just think that the market's, behaving itself. Can I say that? Behaving itself. But really, at the end of the day, you look at some of those factors, the VIX sitting at sort of 15, 16, it's not showing any signs of stress or further put options into the market. And that's a clear leading indicator on stress and how the market is looking. And so trading at 16, it should trade around that sort of 13 to 15 to 16 anyway. So I think it looks okay. I'm obviously a little bit wary that we are coming into that period where the Fed is looking to cut interest rates. And is it going to be 25 basis points? Is it going to be 50? The problem is that once that interest rate starts to get cut, the rhetoric is going to change. And that rhetoric is going to be, are we heading into a recession? And whenever you put that R word out there, it just seems to reverberate across the markets and does unnerve people. But it is a positive sign that we are starting to see interest rates starting to come down. The market has definitely priced it in. And I just hope we can hold these levels and gain some normality and hopefully keep moving higher.
Yeah, it's interesting you mentioned about the VIX, which of course is a measure of volatility. It's also, typically being relatively low, it's typically the sort of the scariest months of the year, September. We're 7 weeks out from a US election. We've got all sorts of other events unfolding in the US.
Yeah.
And the market seems reasonably benign. So I guess that does give you a sense about there is really a strong underlying strength in the market. And it's probably one of the reasons why whatever dips we've had, the little bit of volatility that's been there has been so quickly bought back. And we've seen, I guess, to the same extent in Australia. But let's come back to the Australian market and close to a record high, if not a record high today. We've got Westpac hitting another record, I think, today. If you get a little nervous in our market, you're going to have to be looking at the banks. And I think a lot of people are and wondering about whether it's time to lighten up. But if they do lighten up, where do they put their money? So what would you be saying to the moment who might be saying, well, I bought Westpac. I can remember when it was well under $20. It's almost $33 a day. Earnings aren't going up. Dividends aren't going up much. So if I take some profits, but what do I do with the cash?
Yeah, it's an interesting one because, even 6 months, probably 8 months ago, we were all bashing the banks saying that they haven't moved. They've done nothing. And if you look at over a 10-year chart, they've done nothing. And guess what? Now they're all starting to move. So, look, the banks have done the heavy lifting. We know that's really what's driven our market going forward. And banks hitting those all-time highs, I think it's fantastic. But yeah, you're right. Where do you put that money? Look, obviously, the biggest sector that's seen money outflow is the resource sector. That is the one that has really hurt. But I don't think they're out of the woods at any stage at the moment. We still haven't seen China, their property market starting to fire. We've seen iron ore, that $100, even lower now, looking really, really tentative in there as well. So I think resources and potentially BHP and Rio, at these levels don't look too bad, but I know that they are putting more and more production into iron ore. And so I think that they're wanting to get that iron ore price even lower to get rid of some of those Chinese mines that are sort of that marginal producers. So,
Yeah.
where do you go? Potentially, yeah, you look at some of the resource stocks, they have been beaten up. Gold stocks have started to move a little bit today. More than happy to look at the healthcare space. That hasn't really done much either. I mean, we talked about previously that Sonic or Ramsey. I think you're got to be a little bit careful in that space. But it's really tough to be looking because, you've got a lot of this stuff where there's lots of overvalued stocks that are just sitting there and continuing to go higher. But there's a lot of undervalued stuff, and the resource sector is one. I guess property, the REITs have all started to move a bit. Even Lend Lease, Paul, it's actually starting to look okay now. I mean, maybe you would put into some of the REITs or look to sort of, and they're going to be paying dividends at the end of the year. So you could get sort of a couple, 2 or 3 dividends in a year by buying some of those REITs. But yeah, it's really tough at the moment. And just, well, either we want a real shake up, get this market a little bit lower because we can find some value, or we get a clear progression that we're going to print new highs and the market just keeps going. So it's a bit tough at the moment.
So you mentioned Ramsey, which is horribly beaten up, but then probably with good reason, and also Sonic.
So.
Are you really sort of making the case to invest in those? What do you think of those 2 stocks at the moment?
Yeah, look, Sonic's probably probably the better of the 2. I think for something like a Ramsey. Ramsey, I think overall has really struggled, and there's private hospitals have it's high. It costs a lot to put these hospitals together, and I just don't think that you're seeing a lot of value there. I guess I'm just going on sort of those healthcare stocks that have been beaten down. There's plenty of other ones. ResMed, which is one of my most favorite stocks, and that continues to move higher and will continue. CSL at 300 hasn't done much this year, but it is a very good defensive stock. So yeah, you got to look further out, and that potentially Ansell doesn't look too bad as well. I think that one looks okay. So that would be, but Ramsey, yeah, it's in the doghouse, and it has been for a while. And I don't know if you'd see too much light out there, but potentially they've had one bid that got squashed. Is there another bid? I'm not too sure, but something like that might provide some uplift even at these lower prices.
Yeah, well, one thing you do know about Ramsey, it has some fantastic assets, right, which is so hard to replace.
Yeah.
As we've seen, if we go back to governments trying to build things like the Adelaide Hospital or the Royal Hobart Hospital, they can't be replaced. But at the moment, they can't make a decent return on them either because of the cost inflation, I guess, is part of the problem. So I just don't know where a company like Ramsey goes. But I guess if you're a shareholder like me, I think you just hang on. But I'm not sure I'm ready to put any more money into it. I like the idea of both ResMed and Ansell. What about if you sort of look in the tech space? Are there any sort of standouts in the tech world at the moment?
Yeah, well, like we said, that the wise techs of the world just keeps moving higher and higher. So there's definitely quality and Xero obviously doing very well also. But I think most of your investors or investors out there have seen those kinds of stories. There's one that we've actually been liking a lot is Nuix. NXL is the stock code. That one has had a checkered past. There's no doubt about it. And for all those people playing at home, they will have known that Macquarie listed this one. The stock got up to about $14. And then there was lots of issues with management, prospectus not meeting forecasts and all these kinds of things. And the stock came back down to sort of 50, 80 cents a dollar and it's been trundling along there. Shaw and Partners, we've actually picked up coverage a couple of months ago at around that sort of $2.80 mark. And we think that this one has actually done some really good of getting rid of the past. There's still some issues there, but getting rid of the past and then moving forward. The stock's sitting around sort of $5.35 today. So it's actually done quite well. There's been a couple of upgrades. They had an earnings upgrade the other day. But this is a business where every of these companies have basically getting data. They're getting lots of data, but they don't know what to do with that data. And so Nuix comes in and actually simplifies that data, puts it into a way that management can understand it and people can grow their businesses on the back of that data. They've just started this new program where it actually looks quite good as far as this NEO project. they've got about 1,000 customers, and they've already put around about 20 of those customers on, and they're doing earnings upgrades on those 20 customers. So if they can get the rest of those customers on board and firing, there's further earnings upgrades to go. So I really like that story, NXL, Nuix. It's an interesting one. We're the only ones that cover it in the market. And those are the kind of things that you can make some really good money for clients.
Yeah. Just on the subject of data and data centers, we've seen a lot of money go with sort of the private, or I won't say the privatization, but the sale of a big private data operator. Talk in the paper today about another one called Canberra Data, I think it is. We've had NextDC raise some money last week. Its second capital raise in less than the last 4 or 5 months on a very opportunistic thing to seem to just get some capital so we can invest it. Where do you go with a company like that? Do you think NextDC, which is, it's got a share purchase plan coming up. Lots of people have been involved in it. It's been doing well, but clearly, a couple of opportunistic capital raises. Is that something that, takes your fancy at the moment?
Look, I think the share purchase plan, I think any investor would be silly not to take up the share purchase plan. So yes, I think NextDC is the best and the biggest in our market. We've certainly seen other data providers, and GDC is another global data centers. They've been selling off all of their data centers. And in fact, they really only had a percentage in the name has just escaped me, for the big sale that just happened.
The one that got 24 billion or something, or
anyway. Anyway, so look, a lot of data centers have been hiving off assets because of one, cost of electricity or cost of energy has been hurting their margins. I think overall NextDC is the best best of the bunch. I think you'd definitely stick with that one. We've actually been selling a lot of transurban. And talking about old infrastructure and putting it into new infrastructure, which is NextDC. And so we're really sort of pushing with those data centers. Where does all the data go? Where does all those YouTube clips go? They have to go somewhere. Where do all your emails go? And this is only going to get better. AirTrunk is the business that was sold for 25 billion. So yeah, I'm comfortable with NextDC.
And you're selling Transurban on the basis it's had a good rally. I mean, I remember I wrote about Transurban couple of months ago at about $13. I think it's almost back up to 14, isn't it?
Yeah, this thing's been trading sideways for a decade plus, where it basically sort of in a band. It is at the top end of that band, probably could go a little bit higher. I think the New South Wales government putting a cap on the amount that the people can that the Transurban can get, I think that's going to hurt their business potentially. But it's just it's done nothing. It's at the top end of its trading range. We want new infrastructure, old infrastructure. I think definitely its place in the portfolio. But I'm happy with the new infrastructure, and I think we're going to get a better bang for our buck in something like a NextDC.
All right. Anything else taking your fancy this week, Adam?
Yeah, it's certainly a little bit tough. Some of those valuations and what's going on. It's great to see some of the resources starting to move. The REITs are starting to look a little bit better. Healthcare we've sort of spoken about. So yeah, not much. I think it's more about sort of maintaining this. Are we going to get another dip in this market? It's September. I think September's been pretty safe because we had our dip in August. That's when we lost a fair bit and it's rallied back up again. I just think you'd be holding fire until one interest rate decision, and even so, potentially looking towards the election. I think you could sit back and just sort of watch this thing, because at the moment it's a little bit tough to find some really good value unless you're willing to go the resources, and that is part of a cycle and it will turn. So. But most people have got enough resources in their portfolio anyway. So it's a little bit tough out there to pick a good stock.
Yeah, I think I agree with your observation. I think it's time for a bit of patience. Resources, you have to be really patient if you're buying resources at the moment, but the cycle will come again. But after this sort of rally we've had, it's just sit back. Sometimes you can enjoy the bit of cash around and just wait for the opportunity. But I think it's just a time to be just a little wary and just have to be patient about the market. But a good assessment. But anyhow, interesting discussion around Nuix, which is a stock that I was once in and out of, and I'll have a look at it again. But you're right,
Yeah,
certainly
do,
rallied.
do.
Certainly, Ansell's another one that's worth having a look at on top
Yeah,
of
definitely.
perhaps something like Sonic. Okay, that's terrific. So, Adam Dawes from Shaw and Partners, thanks as always for joining us on Switzer.
Great to be here. Thank you.
Thanks, Adam. Well, that's it for this week. Don't forget you can read about all our thoughts in Switzer Daily, and also for subscribers, the Switzer Report, go to switzerreport.com.au. I'm Paul Rickard. See you next week.